Hey everyone, it's time for an extended version of Kenny's clip. A lot going on the last month or two since I've last done my update. I've got three sections on this one on real estate and our business here, and one on the economy, and then one on stocks, gold, and crypto. Crazy goings on there too. So anyway, they're all looped together, of course, but let me start with real estate. So the infection in the real estate market that has started in the South is continuing to spread through the Southwest, the West, and what I mean by the infection is the lack in buyer demand that is starting to slow down, as well as the softening in prices and the increase in inventory. Like Colorado's inventory is up 50% from the average, not from the lows. It's up 3x from the lows back during the COVID insanity in 2020 and 2021. So anyway, what this spread of inventory is going to lead to is continued softness in pricing. The affordability indexes all are terrible throughout the majority of the United States, and prices are going to continue to soften. If you are looking to buy real estate and not selling an existing property, I would definitely not be buying pretty much anywhere right now. And to the realtors that watch this, I apologize. But obviously, if you're selling a house and buying it, it's not as much of an effect because you're doing both there. But if you're a millennial that or have a kid or something that's thinking about getting in, I would certainly hold off. Prices, the Denver market here is terrible. Prices are dropping. Prices are not dropping as, they're not as visible as the reality. The reality is, if you look at like house to like house, prices are dropping in at least half the states in the United States. Northeast and Midwest are still holding strong. Inventory is starting to surge, and in the Northeast, and starting to gradually improve in the Midwest. And both of those are going to lead to a slowdown in their economies or their real estate markets, and eventually softening in pricing. Their pricing has not been as high as the South and the Southwest, so hasn't gone as crazy as Denver or Salt Lake City or Phoenix or whatever. Those prices are really dropping. The news that you read won't show it because it shows the median house price. The problem is all the high dollar houses are selling, and so that is skewing the volume towards not demonstrating the actual drop in prices. For example, Austin, Texas is already down 23% in price. That's where this started. It spread to Florida, Georgia, and the Carolinas, and then Texas, and then Colorado, Utah, Nevada, California, all that stuff is spreading. So prices are going to continue to drop. How much? I don't know. It depends on what the government does. Who knows with the government world we've had the last 10 or 20 years of intervention and jacking up everything. So, but I would certainly not be buying. I've been trying to sell a property in Denver and have dropped the price already 15 or 20%. If you got condos or townhomes in much of the areas that have built, there is no market for them whatsoever. So anyway, when it comes to mortgage rates, I did expect an improvement in activity this fall because mortgage rates did go back down to 6.25%, and unfortunately it didn't happen. The activity is about flat, if not even a little softer this fall than I expected, even though mortgage rates did go down prior to the Fed cut, as I discussed in the last Kenny's clip. So right now we need more cuts. Today's bond market was very interesting. We've dropped below the really critical 4% 10-year bond level, and this could be the beginning of another 0.25% or more drop in mortgage rates as the economy continues to struggle and slow a bit. So in various areas, and we'll get to that here shortly. Pray for the new Federal Reserve chairman to not be as clueless as our current Powell, because one I'm rooting for is Rick Rieder, who's more of a Wall Street guy, but he has been behind stopping the runoff of mortgage-backed securities. And we've been selling those mortgages that we stupidly bought during COVID, driving interest rates artificially low, locking up the real estate market. driving prices to unaffordability, causing the youth in this economy to not be able to buy houses. So this is all Fed-induced shit show. So anyway, mortgage-backed securities, if they stop running those, selling those, and running those off, that would drop mortgage rates a solid 0.25% right away. So anyway, one flag up for Rick Rieder for Fed. Anyway, moving on to the economy. The economy's been soft. I was talking about in the last Kenny's clip about the jobs numbers that were going to come out in the early September. They did come in horrible at the emergency level rate, 911. And what that actually is 911,000 jobs were not actually there that were reported by the federal government through March of this year. So the last 12 months through March of this year. So the economy was in the crapper prior to the election, hence the change in presidency. And despite the gaslighting of telling people that everything is fine, the economy's strong. The economy hasn't been strong for a year, and it continues to not be strong. The only thing that's holding up this economy is the AI spending in the AI world. Now, that is substantial. That is trillions of dollars, and that is keeping us out of recession, the traditional recession. We are in a jobs recession. It's fortunately not a terrible firing job market yet, but there's a true lack of hiring. I won't go into all the numbers, but we've lost 1.5 million full-time jobs this year alone, and the economy continues to struggle on that part. AI is certainly hurting some of the entry-level jobs as the younger people are having a tough time get jobs. The other thing it's affecting is tariffs and uncertainty. The tariffs has created uncertainty in the economy, and that keeps people on the back burner when it comes to spending, possible job changing, buying homes, etc. So generally, the tariffs are going to be a short-term bump in inflation, but that's not important. If Powell would just get his head out of his butt on that, that'd be great. What it really will cause, it's like a tax on the economy, and some of it will be passed on to the consumer, and that will slow down demand and slow the economy as well. So anyway, when it comes to the Federal Reserve fortunately will be taken over by people that are more dovish because Powell is very late in cutting interest rates. Pretty much anybody that follows the markets believes that Powell is behind here and should have been cutting this year and has not been. Whether it's political or not, I don't know, or he's trying to not be the guy that let inflation back into the bottle. And that may happen. I'm not saying what Trump's trying to do, stacking the Fed, is necessarily the right thing. We do need some interest rate cuts, certainly not as many as Trump's calling for. So anyway, the reality is we do have a new Fed that's going to be coming into effect over the next year, and that is going to affect the outlook for stocks, bonds, gold, and crypto. So moving on to that stuff, the current weakness we have in the economy, jobs, that's probably going to actually improve. We might be in the bottom here. The slowdown in the stock market that I expected in September may be coming now. We're seeing some corrections in the stocks and such, but as in September or as in August when I recommended crypto and particularly in gold and whatnot, there's going to be a growth scare, which I think is what's happening now as the economy slows down. That's why the 10-year bond is going down, which will help the mortgage industry, and also why gas prices are hitting well below $60 right now. And so that's an indication the economy is softening, and that's good for the real estate business and hopefully getting mortgage rates down further. So we did have some interesting stuff happen in the last week that I wanted to mention. We had some interesting bankruptcies in some companies that were supported by private lenders. And unfortunately, you might have heard about private equity. Well, private equity is lending money, sometimes not very carefully. And but then the banks are lending to the companies that are lending. The banks are lending to private equity. So it's still ultimately is affecting the banks. So we had two major bankruptcies last week. One, Tricolor, which is an auto lender in the South that was lending mostly to illegal immigrants. Suddenly, 33,000 vehicles have disappeared, probably sold in Mexico City. But billions of dollars lost there, and that is reaching through other banks and such. And then even a bigger deal was First Brands, which was a auto parts manufacturer, and they were lending on invoices that they had out. They were getting money multiple times, so they were fraudulently doing stuff. And their CEO just this week said, I don't know what happened to that $2 billion. And by the way, there's zero of it left. So $2 billion has just vaporized. And this is starting to affect the banks and causing that growth scare. And could it be the Bear Stearns moment of today, and in a year and a half from now, we have a Lehman moment? That's possible. We have a lot of leverage in the economy right now with all this private lending and private equity running the economy now, whether it's being owned in real estate or lending to all kinds of crazy AI circular investing. So anyway, so what do you do about it? I think we had also, oh, by the way, crypto crapped the bed on Friday, and that was an issue mainly partially because it's tied to risk assets like NASDAQ and such. But there was an issue at Binance that had a liquidation and an issue with their stable coin that went to 70 cents, which isn't supposed to happen. That caused a lot of margin calls, and it caused a lot of people to get margin calls and all their crypto to get sold against their wishes. So don't be leveraged. Don't ever be leveraged in crypto. Don't be leveraged in anything, in my opinion. But anyway, I think stocks, we can't, they're overpriced when it comes to many measures, but we do have a lot of stimulus coming in the economy with the bill that the administration passed. There's going to be large tax refunds this February and March. In April next year, we also have huge incentives to move manufacturing here, which is starting to show some signs of waking up. And there's some forward-looking indicators that are showing some potential movement in the future. So we might have a glitch here and some sell-offs. We do have to be careful, though. Everything is overpriced and over-leveraged. So there could be the next crisis coming, but usually it takes a lot longer than you think. So when it comes to gold, record prices in gold. I've been adding to gold this year. Not enough, unfortunately, but gold and silver have broken through 4,000. We broke through 3,000 a little while ago and are just raging. There's nothing right now that's indicating a slowdown. Gold and silver stocks are up double the price of gold because with oil prices low, mining is cheap, and we have record prices in both silver and gold. Silver broke through the $50 barrier, which it's never been at, and so that's probably a precursor to $70 or $80 in silver, and the miners could easily double again on that. Risky stuff as you get this high, but gold really has changed since the Russian invasion of Ukraine. People are using it as a central banks throughout the world are using it as an asset that they want to hold because they don't trust the U.S. or the Western economies, whether it be Europe or the U.S., because we stole Russia's stuff. And so if we had treasuries or whatever, we stole their boats, we stole their whatever. So China is now buying less treasuries, and many other banks, friend or foe, are buying less treasuries. And that also hurts the mortgage market, but it also has led to gold being more of a bigger deal down the road for a long period of time. So I'd stay long gold. Right now, it could easily go to 5,000 and drop back down to 3,500, but I don't know what it's going to happen in the short term. But having gold in a world that is increasingly distrustful of each other and of the U.S. dollar. The Trump administration wants to lower the dollar, and they've done that this year so far. That does drive up stock prices, by the way. So if they get their wish, we've had a little backup in the dollar, and it's gotten a little stronger in the last few weeks. If it starts going back down, that will drive the stock market back up. So we could easily have crazy record highs and a melt up over the next 3 to 9 months. I don't know, could be a year or two, who knows, but be careful out there, and definitely have some gold. I think cryptos is a decent little buy here, although that's really risky too. But it is something that is also part of the gold type trade, getting out of risk assets that have a correlation to regular dollar assets. So anyway, thanks again for listening to Kenny's clip. Hit the subscribe button as we are going to be doing these more regularly, and hopefully get more viewers. I appreciate your interest. See ya. And a like or two wouldn't hurt.